All right, we are live. It is Wednesday. What is it, July 15th? So I got Joel Farrell here. As you see, Lauren's not going to be able to join us today. She actually had something come up last minute. But we do meet the school member Wednesday now. But I have he's actually, we used to collaborate on a regular basis. So I do have Joseph Catropalia here. So how's it been, man? It's been a while.
Good. How you doing, Mark?
I'm doing great. And if you also don't know, he also did an episode on Joel's podcast. Jeez, was it? I think you did it first on his, like maybe
I,
3 years
think
ago,
that
maybe?
might be true. I mean, that
Yeah.
was probably I don't know, was it 3 or 4 years
Two,
ago?
yeah, 2 years ago, something like
Two,
that.
only two. Yeah.
So I'll definitely throw their channels in the chat. I did not check. I know Joel is streaming live also on his YouTube. So if you haven't, jump over there, subscribe. But Joseph, for those that may not know who you are, especially some of the newer members in school, maybe quickly, 60 seconds, introduce where you're at, what do you invest in, kind of your story real quick.
Yeah, it's really tough in 60 seconds because I'm old, and I've changed jobs like every 6 months. I did for the first probably 10 years of my career. Um, I am a real estate agent, mortgage loan officer, both of those based in Texas. I run a small agent team in San Antonio. We only work with investors. Almost all of our business is buy side, out of state investor transactions. Occasionally, we end up taking listings because sometimes those people want to sell. Been in the industry, 20 plus years. I bought my first investment property in 2005, my second one 2 years later. Another year after that, I bought, I think, 10 units. Did a whole bunch of stuff in between, worked in commercial real estate in a bunch of different roles. I've worked in appraisal. I'm a former attorney. Had my real estate license in a bunch of states. So kind of bounced around quite a bit. But for the last really 8 years, been in San Antonio, focused on helping investors buy here, find deals here, almost entirely residential investment property, very little commercial anymore. Um, and yeah, a lot of you guys know me as posting about. I know I told you it was going to be long. Sorry. No, you know me as posting about fractional real estate. I've sort of dialed that back over the last 6 or 8 weeks, and I don't know. Maybe we'll get into that as well.
Yeah, definitely. Before we dig into some other things, the first thing I want to do, because I kind of put it on the thumbnail and maybe in the description, your hat says the real estate guru. So that was kind of a
Right.
little joke, right? So, did you just buy the hat, or I mean, like I feel you're very knowledgeable in this space, though.
It
But is
is.
it kind of
It
a
is
play?
a. It's a custom made hat. I've had. This is probably my fifth or sixth one of it. Um, it's I bought it kind of jokingly, right? Because people think like people use it as a derogatory term, like they're an online real estate guru. I wear it everywhere except for church, and it is fantastic for starting real estate conversations with people. Because if you wear a real estate hat that's got your logo on it, people know if they ask you about it, you're going to try to sell them something. When I wear this hat, they don't know if it's even a joke or not. It's just like they just want to know why. What is that all about? So I wear the hat for that reason. But I do, it started off. I got called that a lot by people, really just because I'm way overeducated for the job that I'm doing, and I feel like because I've bounced around so much, I have like a really broad, it's not super deep in certain aspects, but a really broad amount of knowledge in the industry. So I don't know. I feel like it's really hard for you to pick a transaction, like either an asset class or a type of transaction that I haven't at least done once. So it is a little bit, it gives me an excuse to tell that story, right? Been involved in over $3 billion worth of transactions in the last 20 years. So I feel like I could claim that, right? But mostly it's a funny hat.
Yeah, absolutely. I think especially where we're at in kind of real estate right now, a lot of so-called maybe gurus have taken it on the chin recently.
Right.
So it is
Right.
it is kind of fun. But I do see I'm not sure. So Chris, who's in Arizona, who was on the weekly show a couple weeks ago, he says if guru was an acronym, what would it mean for you? I might have to take some time to think about this. But I see Flavio tuning in. But Joel, you got anything to ask Joseph? Because you guys have known each other for a while too, also. So
Um, well, not putting me on the spot. I know we talked about
Well,
some
okay.
fractional stuff,
How's
but
this then? Well, so like I said, Joseph was on your channel first, your podcast. What made you reach out to him? Why did you want to interview Joseph, or what made you bring him onto your channel?
well, at that point in time, we did talk about some fractional investing type stuff, and the real estate investing side of things. I mean, people getting ahead. I mean, there's just so many different ways that people can get ahead, and people's doing different types of strategies.
I actually
And
think the first time we talked, you had put something out about, have you ever done a no money down deal or something like that? And I came and did like a short thing with you. I could be misremembering that. But I talked about a deal I did really early on.
yeah, it's been 3 years.
Yeah, very long. But I think
forget.
that's what, because I think it was even before I got into the fractional stuff. Because I think I met you
Okay.
first, and then I met Mark, and I knew both of you guys before I got into fractional real estate. I'm pretty sure.
I think the one big takeaway for me is like if the people follow you on X, or even tune into your YouTube channel, which you definitely should. I think you can quickly pick up how knowledgeable you are. So even Jared, who's in our community, who does Rent by the Room in Arizona, he always talks about how you underwrite deals and how he's always even just a fractional, how you go to watch your fractional. Maybe it's a little bit different, but how you're evaluating the properties there. So I think that's one of your strongest skill sets. I mean, was that something you easily picked up on when you first got into real estate, or how has that underwriting process come for you?
So I think it didn't necessarily come naturally to me. I have a master's degree in land economics and real estate from Texas A&M, which is really, and I've mentioned that because it's really more like a real estate finance degree, even though they say it's land economics. And almost all of those classes were about financial due diligence, building analysis. We did had development classes, finance classes, where you really like learn to build Excel models, when people still really all use Excel models, although I think a lot of us still do. And so I learned a lot there. But I think having a bunch of different jobs, and like through the crash, I worked for a while, I worked in consulting, and I really got to go through literally thousands of foreclosure files from a couple of different lenders, and understood so much about what could go wrong. And then while I was in law school, I worked as a clerk at an attorney's office who all we did was foreclosures. And I think really seeing the downsides in a number of different ways in real estate made me always want to focus on the downside, right? Like, I mean, there's just so much that can go wrong. In real estate, it's not an asset class where you're going to get these huge multiples, right? Like if you invest in stocks, you can lose on most of your investments, but have a couple huge winners and you do perfectly fine. Real estate's not like that, right? We have to rule out almost all of our losers, or we're never going to, you don't have a high enough average return on deals to do it the same way. And so it just, I don't know, something about just seeing the negative side over and over again has made me really interested in looking at deals in a way that I'm trying to, avoid as much risk as possible, and even if you do that, you're still going to have losers.
Yeah, I think the one thing too, when I connect with you and talk with you all the time, is I notice that you fit very well. You kind of so you also kind of, I don't know if you refer to yourself as that, but lazy in a sense. So like Dion, right? Kind of a lazy investor. But so you have that blend of Dion, even Michael Zuber, and even Coach Carson, kind of that small and mighty investor kind of mindset. But the one thing I always kind of pick up on is Sub 2 was very popular at one point, and you also have kind of a legal background to some extent. So I always hear you kind of talking about the risk of doing those type of transactions, and are maybe against it, or try to talk new investors out of doing that. So why do you kind of feel that way about that?
So Sub 2, I mean, it's a specific one, but a lot of creative real estate financing strategies are perfectly legal if done the right way, but they're taught. But okay, we have, I only passed the bar in 2 states. Every state has different laws, especially when it comes to real estate. Sometimes they're very similar, sometimes they're wildly different. A lot of states have specific consumer protection laws. most of the the fake gurus that are teaching this stuff teach you a strategy, a lot of times give you forms and say this is legal in all 50 states. I mean, that's laughable to most attorneys. I mean, I'm sure they found an attorney that was willing to give them a form that they said was legal in all 50 states, but most of the time, anything you do, if it's not tailored to your state laws, there's going to be ways to get in trouble. And I think I really benefited from early in my career. I was in New Jersey. New Jersey has a ton of consumer protection laws, so like all kinds of the creative stuff I tried to do there early on, I was all about creative financing, and I've done a lot of owner financing and stuff like that. But I ran into all sorts of different ways, and I had a real knowledgeable real estate attorney there. So I ran into all different ways that things that I was trying to do were going to get me in trouble. And I actually, I took a class from someone at a local REI who she was teaching a creative real estate strategy. She was teaching this all over the place, like traveling the country, but she was local to our area. 2 years later, she was in jail for exactly the strategy that she was teaching. And so, it's too easy to make money in this industry without having to play in the gray area. So I don't know. I know it's like really appealing to just like, oh, let me take over that 2% mortgage. But if you're not doing it the right way, if you're not hiring an actual good attorney, if you're using some form somebody gave you online, I just think you're opening yourself up to a ton of risk that for me just isn't worth it. I actually know several people personally that went to jail after the 2008 crash. And that's when it happens, is after a crash, right? Like when everything's going well, nobody's prosecuting, everybody's making money. Who cares, right? But it's when things go sideways that all of a sudden lawsuits break out, enforcement action starts to happen. And then things change really quickly when everybody's in pain. And I think that's what a lot of the people sort of miss. And I do. I just think this is a really easy business to make money in, doing things the right way. So I don't understand why people want to push into gray areas so often.
So this is maybe for both of you, because I'm not sure how much you do on the lending side, Joseph. But like Joel, for you, do you see, I guess, a lot of new investors getting caught up in interest rates, and that's why, to kind of, even like Joseph's point, they get caught up in that low interest rate, and people are kind of attracted to doing sub-2 transactions and things like that. But do you see a lot of new investors focusing on interest rate more than they should?
Well, when you say focus on interest rate, you're talking about to make a deal work, or hey, I'm not gonna proceed on a deal because the rates are being too high, or what do you mean?
Both. You can start off with one first, and maybe perceiving rates are being too high, and that's what's preventing it. So we'll start with that one first, then.
Well, there's two lanes, right? You have people buying primary residences, and I think you're going to see probably more people that are interest rate sensitive on primary residences in terms of just the psychology. Whereas on the investor side, it's just pure numbers, right? The numbers, either they work or they don't work. And hey, this deal pencils out only if I buy it at this price below what the listing price is. And so, it just depends on the deal. But rates, they've been flat for 3 or 4 years, and so either you're going to do something or you're not at this point. We've been in this environment for a while, so rates are what they are. I'm seeing less of that now than maybe a couple years ago.
Joseph, your take on that?
Yeah, and so I am very new to the residential lending side. I actually just got licensed in Texas. I don't even think it's been a month. So I used to work in, like, very early in my career, I worked in commercial mortgage brokerage, and that was sort of where I got my started on the lending side, and worked in loan servicing and whatnot. And then, so I haven't been taking mortgage applications for a long time or something, on the residential side. That's not. But the main reason that I decided to do this is I do think, I think investors get caught up with bad financing advice a lot, right? Because there's been a lot of people that I think a lot of them do move into this subject to and other creative stuff because they see the high rates and they don't understand how to make deals work. I think there's a lot of like I think a lot of lenders are giving clients bad advice on, I mean, you heard that the people would always say like, date the rate, marry the I don't know, marry the property, something like that, which I think was just crazy that you had a whole industry saying this to people. Like it just, I mean, in part, the concept I think makes sense, right? You're buying the asset. The financing is going to be, yes, you can change it, but it's not, I guess essentially I want to work with somebody who is truly advising clients and actually helping them like come up with a strategy, figure out what works, versus like I have this product and I'm trying to sell it to you. And I just very rarely could find that in a lending partner. And so decided, you know what, I've got the way I have my team set up, I don't really work that much. And so I had this huge chunk of free time. I had been focused on fractional real estate with it. That was sort of hitting a wall. And so I was like, why don't I get my lending license and actually help our same clients figure out, like, because I think there's a lot of strategies that can be used with conventional financing and maybe combining a little bit of creative deal structuring, that people just, it was hard to find someone who would help with that. And so that's why I went in that direction.
Yeah, I also, I'm not sure what direction you want to. You brought up fractional real estate. I'm not sure. Like you said, you're kind of taking a step back from that. I also noticed even Zuber's channel. I haven't seen Real Bricks on recently, so I'm not sure if he's kind of taking a step back from the fractional space. But do you want to talk more about maybe the fractional side? I know you do notes also, right? Like what? This is really about you to also share your journey. So what do you think?
Yeah, no, I mean, I'm happy to talk a little bit about that. I did put out like an hour-long video explaining why I'm stepping away from that. And I say I'm stepping away. I still own some. I'm still probably going to do an interview on my channel sometime coming up on a new platform that's going to be launched in the next month or so. But in general, it just turned out, I think that I still am a big believer in the space. I think once it's really figured out, it's going to be a great option for investors. At the moment, it is, I'm trying to use the tools as they're building the tools, right? There's, I think, 6 different platforms I had money invested in. There's really only one that I like. I mean, and even them, I've seen a somewhat of a decline in their average deal, because when they were trying to put out a deal or two a month, they were putting out amazing deals. And my early investments with them, especially their pad splits, were really good. I mean, they're early, they don't seem to really understand short-term rentals, and I'm talking about Mogul, just to be clear. But over time, their average yield on deals that they put out has just gone down, because they're putting out, multiple deals a week at this point. I mean, they just crossed over 100 that they've put out total. And so I just think as they've ramped up their acquisitions, they're not able to cherry pick as much. So I think that's, but even with that being said, they're the only one that I'd be willing to put money in and just leave it there long term and think, maybe I have a good shot at this one working out. All the other platforms, I think, for a myriad of different reasons, I just can't see myself putting any real amount of capital. And I just had, over the last couple of years, been experimenting. I put an amount that I was like, okay, if I lose this, I'm not going to cry about it. But I got to a point where I was spending a ton of time on it, and it didn't seem like, if I wanted to keep spending that much time on it, I probably needed to put 5, 10, maybe 15 times as much capital as I already had for it to be like a worthwhile endeavor. And I didn't trust any of them enough to do that. And so that's kind of where I stand.
Your guys' takes might be a little bit different than mine. I almost feel like it's kind of even the AI space right now, where I don't know which platform or which one I prefer. It's like I'm trying to learn it as they're building it out. Almost,
Right.
it seems like, and I'm chasing it to some extent. But I see Gus tuning in. Gus is my Tuesday regular guest. But I think he's asking, because he may not be sure, but can you maybe quickly explain what fractional real estate is? Maybe?
Oh, sure. So this is when there's a number of different companies online. Mogul's one, and that's the one that I like the most. So I feel comfortable mentioning it. But still, do your own due diligence on them because there's a lot of risk still. But so they go out, they identify a property, they buy it, or they don't actually buy it. They go to raise funds for it, and it's sort of like you're buying into a syndication. But the legal structure is different, and you can buy on that platform. I think your minimum purchase is $250. On some of them, it's as low as $10 that you can buy shares in, and so it gives you the opportunity to invest in these deals. And in most of the platforms, every share is equal. It's not like you have where a syndication has like the sponsor and the LP. Here, it's everybody gets to vote on decisions that come up. The platform themselves, hopefully on the ones that I like more, are responsible for a lot of the day-to-day decisions. Some of the platforms, though, it's just really the Wild West, and like we as owners of pieces of the deal all just vote and do all kinds of stupid things. I mean, that's, I'm thinking about Lofty when I say that. Like there's that one is like you just have absolute free reign, and the platform started to reel it in and put some guardrails. But so then as an owner of this small piece of the deal, you get rent either on a daily, monthly, weekly basis, depending on how it's set up. And then when the property sells in real life, you get a piece of the upside as well. So.
All right, I'll throw Joseph's channel also in the chat. So like he is stepping away a little bit from the fractional side, but are you gonna leave up the old videos on?
Yeah, I'm not taking them down, and I will still put out a video whenever I think there's something really noteworthy to talk about. I had been doing a video almost every day on, okay, this is the next deal I'm looking at, and I was spending hours every day looking at different deals that were popping up on different platforms, and that's where I really thought after a year of doing it that I would start to put some real money at work, and just got to where I just don't feel, for me, the risk reward isn't there, especially because the deals that I do in real life have just always had higher returns. And, and I knew I was going to give up some of that to invest in a more passive manner, but I think it's just giving up too much for also taking on too much risk.
Are you able to explain some of the returns and cash flow, maybe earlier on versus now?
Yeah, on those. So, like the earliest pad splits I bought with Mogul, I'm getting about a 10% cash on cash return from them. Their more recent ones, it's down to like 8 is what their average year one yields are. So it's, it went down 20%, but it's still, it's a high single digit. It's not terrible. If you took your average new investor and said, hey, go buy a deal with an 8% cash on cash return, they're probably not going to be able to do it. So like their acquisition team's pretty good. Now, if you look at like Arrived or Real Bricks or a bunch of the other platforms, their deals are more like 3, 4, or 5% cash on cash returns. And I know, Mark, you mentioned Real Bricks. I know when they first came out, I was pretty critical of them. Their website originally advertised 9.2% yields. I actually did a video calling them out. They called and talked to me. Well, I went through their numbers and they changed it like within a day down to 6%. I still didn't believe the 6%, but they kept that up for a long time. Now all their new deals are advertising between 3 and 5%. And I think that's the real number that the types of deals that they're buying are going to yield. And then, they all have projections about what you're going to get based on the appreciation, but those are just projections. I think some of them are doing a good job of finding properties that should do well appreciation wise. But I think that I think most of them are picking a number that's too high, and a lot of them are using like the last 10 years of trends to trend forward, which is absurd, right? Like, I mean, we've had such a great run over the last decade appreciation wise, like to assume that is going to continue, I think is just too strong of a number. But so all in, maybe low teen IRRs is what I'd expect, but yields on my favorite platform, still around 8% year one. And again, that's their projections, and a lot of them have hit them or done better on their pad splits. Their short-term rentals, they seem terrible, although apparently some of their more recent ones they've been able to do well. But yeah, the other ones are all. It's really hard to break 5%, 5 or 6% without just buying. A lot of them you have the ability to buy discounted shares or tokens or pieces from other investors. And that's how I had primarily done well on the other platforms. Like most of them, their stated yields were too low. But if I could come in and buy out another investor at a discount, all of a sudden it starts to make some sense to me.
I see Coach Nick tuning in from his trip or 2-month trip around. So he'll be back August 1st, looks like. So it looks like we'll be picking up the weekly Bitcoin wrap up. He is still big on Bitcoin, but he is down on maybe some other things that are going or involved with Bitcoin right now. So we'll definitely dig into that since he's been gone for a while. But I did, Joe, you got anything else before I throw in some of the questions or comments? Okay. Brady, hey, good morning, Brady. He said, if the deal doesn't work in a high rate environment, I don't think I would consider it much of a deal. Personally, I'd rather have high rates than low rates. Reduce competition. You guys got any thoughts on that?
This is one thing, and I don't remember who, somebody did a video about this recently, but it's something that I've thought a lot about in the past. Real estate is one of the only investments that people look at the financing first. So like I buy precious metals as well, right? And I buy them all cash. A lot of people when you're investing in stocks, you don't say, hey, what's my margin rate today to make those stocks work? Like most of the time you're buying it in cash. When you're looking at real estate, all of a sudden people are always comparing the real estate to the interest rates. But I think this is a good opportunity right now, especially if you have the cash to do it, to go buy assets that it is a decent yield on the actual full cash purchase price of that property, and just adjust your financing, the leverage level, to a point where it works for you if you don't have the ability to own it all in cash. I mean, I understand I don't want to buy properties where my cap rate is lower than the interest rate, lower than the interest rate that I'm paying. But as long as there's some positive leverage, that's fine. And if not, if I can get a great asset and I'm holding it in cash right now, I've done that a little. I bought some all cash properties, and then figure out financing later, right? And if not, but the deal itself has to just be worth holding as it is. And I think that really low interest rates made real estate investors over the last 10 years or so think that you should get a lot more yield out of an investment than I think you should.
Joe, I know this is your space, but would you rather have high rates than low rates? I mean,
Well, I mean, yeah, the competition part of it, everybody and their brother was buying real estate in 20 and 21 with rates low. But if you are trying to build a portfolio and the competition part of it, yeah, I mean, higher rates means less average people getting into the game. And I think the people that I'm seeing be successful are the ones who are figuring out ways to be able to not only buy good deals, but to be able to push rents, whether it's changing strategies into rent by a room or pad split or short-term, midterm rental. I mean, the ability to make a deal work is harder now than it was because prices haven't come down. I mean, you have a record number of low of transactions. I mean, at least of what's on the actual MLS. We haven't seen this low of transactions since I think like the mid 90s. So it's harder to make deals pencil out. So you got to figure out ways to be creative. And so the people that are winning are the wholesalers, the people that are buying stuff off the market. They're the ones who are finding random people.
And Joel, this is one of the things where you hear that a lot, right? It's harder to make deals pencil, but this is exactly what I'm talking about. Like when you say pencil, you just really mean it's harder to find a deal that I can lever up 70% or 80% and it makes sense. But the actual, deal itself, the how much I'm paying for this property relative to how much cash flow it's spitting out, that's not significantly worse than it was 2 or 3 years ago, right? It only doesn't pencil because of the higher rate.
I would say 2020 middle of 2022 to now, or 23 to now, is the same range of time. But like 2021, right, is your unicorn, and then before
Right.
that, we're in the same kind of a boat where things are just slow. And
Yeah.
I think we're talking about real estate versus, say, stocks, or Bitcoin and crypto. We're two completely different, even asset classes, but also mindset. I can go take my $500 extra savings from a paycheck, and go buy a couple shares of a random stock.
Mhm.
I can't take $500 and go buy a property. I got to take months, years of saving to go buy the next property. So it's just a completely different ball game in terms of just concept. And when you're talking about buying a $250,000 duplex in Missouri versus $200 of, SpaceX stock or whatever, like they're just two different ball games.
Right. No, I get that. And I think that that's what drives people to be so focused on the financing, because especially earlier in your investing career, yeah, buying it cash might not be possible for a lot of deals for a lot of people. But I still think that that should be the way that you're initially thinking about the deals first, right? Like before you think about, okay, does this work with financing? It should just be, is this a good deal on its own? And then, okay, let's see how we can lever that deal. Like it's, and maybe it's, we can put 60% leverage on it, and or we're paying some extra points. And there's a lot of different ways that it will be, it'll carry its own financing versus versus just, a lot of people just think if this deal doesn't work at 80% leverage, then it doesn't work, right? Which I think is just a silly way to look at real estate, because it's not, because you don't look at any other investment that way.
Well, I think you hit it on the head, because most people, especially if they're earlier on in the journey, they're going to look at just pure cash flow. Hey, this deal, it cash flows $500 a month. Maybe I put in an extra 10-15% of capex or whatever, or vacancy, and maybe I make $300 a month. Oh, this is not a good deal. I'm gonna move on. Whereas, yeah, if you're in the game and you get more resources and cash to be able to be creative on how you're gonna structure a deal, you're probably gonna go off of, okay, if I bought this thing in cash, what's my net operating income? What's the cap rate, et cetera, et cetera, et cetera. So I mean, I think it just kind of comes back to the fact that the novices aren't really continuing to scale. The people who are seasoned and experienced are the ones that are continuing to find the deals and make the deals work, in my opinion.
Yeah, and I guess so. I somewhat agree with that. I think partially my worldview on this is a little skewed, because I work with a lot of brand new real estate investors, but they're not, you know, minimum wage type earners. Like a lot of my clients are either tech workers for California or finance people from New York, so they have bigger chunks of cash to put into something, and so maybe don't have that, have a little bit different limitation. But I honestly think that as a community, like as real estate investors, we have been so overly focused on the cash flow of deals, that it's prevented, like everybody I know that's done really well in real estate, myself included, like almost all of the money that I've made over the last 20 years, it's something like 80-20 equity versus cash flow, right? And even the people that are really cash flow focused investors, I think most of them have made more on the equity side than they have on cash flow. Now, a lot of them have never realized it because they hold forever, which I think is another discussion to have. But I think that I understand. I think cash flow became the main focus, I think, after the last crash, because so many people lost properties. But they were doing deals that were like negative cash flow and dependent on refinancing at teaser rates every 6 months. Like I knew investors that literally refinance deals every 6 months to a year because you could get these new low teaser rates. Yeah, obviously that's a problem, but I think that I think very few people really build the type of wealth that they imagine in real estate through the cash flow side of things. And so, yeah, I mean, I'm really happy to buy a deal that I think is just over neutral cash flow wise if I think I'm picking up 50K in equity the day that I close. Like that's the sort of thing that I get really excited about. And I think that a lot of the investors that I work with, that's more the mindset than like, what does this cash flow look like? It is, how am I building wealth through this asset? And I think that shift comes along with a shift in the way that we look at financing as well.
Yeah, I do see some comments kind of touching on that point, and that's, we'll get to that, but that's also kind of why I think Dion agrees with your stance for the most part. It's just, the cash flow. I think Brady touches on it later on, but it's kind of the cash flow is what's gonna, that safety net and what's gonna help people, especially early in their journey.
Right.
So the equity play is, yeah, once you get more experience, and like you're saying, you might take a smaller cash on cash return because you're getting a property that the equity is going to build, or it's in this great area. So I think definitely it's a great point. Is just sometimes it's hard to explain that to new investors, and if they put them, and if, let's say they don't have a solid W-2 where they're generating enough income to cover certain things, where that smaller cash flow, I think, definitely can put them in a bad spot. So and to your point, like 2008, right, if they didn't have the cash flow coming in, people were underwater. But let's see, I see Frank tuning in. Quickly, I'll say, everyone, if you haven't checked out Frank's new merchandise store, definitely go check it out. He's coming out with some new product. He even dropped this one. I'll just show this one real quick. I don't know if it's a limited edition one, but he did come out with this. I don't know if he was just playing around or what, but there he came out with a Crocs version. But I don't think this might be on his site yet. So, but definitely check out Frank's merchandise store. But he does say, Joe, in Joe's experience, when he's taken a class or course, has he found more often than not it might contain questionable material or something that might get a novice in trouble?
Almost always. Like, I mean, depending on where the course is, right? But I mean, there's even courses that I've taken that were like approved CE courses, which are like continuing education for like realtors, or even that are, talked about some really questionable strategies. And I think it is. I think the big thing, one, there are strategies that work for you if you have plenty of capital, a big safety net, and you're using, you have your attorney that's actually writing up paperwork the right way. But that's not necessarily the strategy that someone who's brand new on a shoestring budget and without proper representation is trying to accomplish, right? And so I think that a lot of times it's not that it is false information, it is just packaged in a way or given to the wrong person, in a way that's just going to get people in trouble. And especially because people just hear what they want to hear, right? I can buy these deals no money down, like, the stuff like that. And I mean, I got started, the very first real estate course that I took, I bought Carlton Sheets late night infomercial, no money down course. And honestly, it was one of the most comprehensive and best real estate investment courses I've ever taken. It came on cassette tapes and a VHS. I had a VHS video and I had cassette tapes. So that's, how far back that I got into this. And it was, but it's not something new, but I think with the internet, it's easier to find these people. And yeah, I mean, honestly, I don't think that you can find a guru today that is teaching a strategy that wasn't included in Carlton Sheets' original course. Like, he did subject to deals. He talked about wholesaling before it was called wholesaling. He used to just call it flipping contracts. Anything that you can think, a lot of stuff that you don't even see anymore. Like, he had creative strategies with zero coupon bonds, trade, using the exchanging, using your boat for a down payment, giving someone a car as a down payment. Like, he had all kinds of stuff. There's nothing new in real estate. Like, whenever you hear all these, like, subject to isn't a new strategy. Like, and it was actually one of the things is, it was a lot of these don't work today because they were popular in the 70s and 80s, and all these states saw people get taken advantage of and said, okay, now we have consumer protection laws specifically targeted at these different activities. you know, and that's why, yeah, I don't know. I think that there's tons of courses out there that have terrible info, and it's tough to, yeah, for someone who's new, it's so tough to know what's true and what's not. I mean, you know, and you have everybody in the, and, you know, and it's one of the things that I wish YouTube would do is force people to disclose when they have a paid guest on their show. Like, there's a lot of big channels that, you know, we're familiar with that have, you know, you see some guests come on and they're like critical and asking tough questions, and they're like, hey, what's going on here? And then other ones, and they're getting all softball, and it's like really almost a, you know, an infomercial for whatever the product is. And it turns out a lot of those are because they have deals that they're getting paid to come on the channel. So yeah, I mean, it's really hard as a new person to figure out when I'm just being sold something and when it's a good strategy. And so I think the simplest strategies early on is what people should do. You know, I think it's mind blowing that a whole bunch of new people got into wholesaling in the last couple of years. I mean, that used to be something that if you were an active investor, you know, I wholesaled a couple of deals over my career, but it was, I got something locked up and it just wasn't the right deal for me. So I'd send it to somebody else. And I think that you know, it should be an advanced strategy that you should know a lot about, but it's instead, you can tell I mostly do videos where I'm talking by myself. I'm sorry. I'm just rambling.
No. I was going to clarify that I do not pay Joel to join me every Wednesday. I want to make that clear. None of my guests I'm grateful they join me. Like I said, Cody on Monday, Gus on Tuesday, Joe and Lauren on Wednesday, and Emily Fridays, and Coach Nick on Saturdays. So, but Trade Better, who was in the fractional community on your Discord, he's asking, did Lofty break you, Joseph?
Oh, it's a good question. I mean, like, they're the ones that, like, I think they have the business model that has the most potential, and they just make terrible decisions over and over again about not providing. One, their transparency is pretty bad. Like, they're required, because they are a marketplace, and so anybody can bring a property on there. And they have recently increased the scrutiny that they put on, you know, the people that are bringing the deals. But, you know, you can go on one of their web pages, see info, press the button, buy tokens, and none of the info on that page was accurate or current, right? And they'll be like, oh, well, you needed to look in the Dropbox, and that's where all the current info is. The stuff on the listing page was like 4 years, you know, 2 or 3 years old at some points. But it doesn't clearly say that. They just have a link to this other info. So, I mean, they did a lot of stuff that drove me crazy. I do think there's, you know, but there's people making money on there primarily with trading on Lofty, because the prices swing really wildly. I mean, I know a few guys that are making really good money, and I made good returns on there when I was spending a lot of time on it, but good returns on small sums of money. You know, that was one of the problems with that. Anytime I tried to buy more and more of a property on there, my purchases pushed the price up too high to make the deal make sense, because it's such a thin market. So, but yeah, I mean, Lofty they definitely were the ones that annoyed me the most. But primarily because I think it is a fantastic model. But the guys who started it knew absolutely nothing about real estate. Like, and so none of the normal protections you'd get in a deal. So you could sell onto their platform properties that had there was no title insurance in the transaction. They weren't finding out if the utilities had been paid up, you know, if there were back utility bills that were attached to the property. Like, I mean, some of the stuff that is like the most novice investor would not have made these mistakes. They were doing platform wide.
I think Coach Nick is taking a jab at Gus a little bit, but he says, I'm big on the NBA and down on LeBron James too. Because as I mentioned, Coach Nick is a Bitcoin.
Did you see his earlier comment?
Which one? Whose?
Coach Nick. He says, "Are you drinking?"
No, I don't see that.
Rum and Coke.
I was gonna ask you that. I was gonna ask if you're taking a part of the Dion's you can't drink all day if you don't start early mindset.
No, it's cold. It's cold brew.
Let's see.
But he talks about LeBron signing to the Warriors, and I hope that doesn't happen.
Hey, Ellis is here. Ellis is he's been on Gus's YouTube channel a few times, the Behind the Doors podcast. And I want to remind everyone, I mentioned it yesterday. A lot of people may know who Dr. Joe Asamoah is, but I was luckily invited on to a podcast with him and on Gus's channel. So that'll be dropping on Friday, Behind the Doors. And also because of that, Dr. Joe will be joining Gus and I live next Tuesday. He does Section 8 in a very expensive market in DC, and he's been on Bigger Pockets, and he focuses on tier 1 tenants. That's his strategy. Yes.
I've watched some stuff from him. He is a very interesting, like his business model is extremely interesting, right? He focuses on keeping tenants for like decade plus. I think if you're going to do Section 8, that's the way to do it. Like, I mean, I think that guy, you know, and I don't know him personally. I've watched a couple interviews with him, and I don't remember where else I saw content from him. But I think it's a much better use of the Section 8, you know, strategy than the way. And I've owned Section 8 units myself. I think it, you know, it varies whether or not the strategy works. Varies very much on the local housing authority that you're dealing with. But yeah, I like him a lot. I think that the way he goes about doing things, and I mean, he's providing a fantastic service for his tenants as well. So
yeah, absolutely. He's definitely great in his niche strategy, whatever you want to call it. But he's dialed it into where, like he says, I think Section 8 does get a bad reputation, but he's like you said, he focuses on tier 1 kind of areas where, if you look at the zip code, you know, you're going to be, and even I think I looked into my property in Hawaii to do Section 8, and the housing, I was like, why do you want to do Section 8 in your zip code? Because you know, it's a little more expensive area, but that's also why it limits the kind of the competition in that zip code, and a lot of people want to try to live there if they have a voucher, right? So, but he definitely focuses on that. He looks at adding an extra bedroom because Section 8 is based on bedroom count, and that's how he increases the rent. And like you said, Joseph, he had a tenant, I believe, that has been there for 30 years.
yeah.
And that property was on a 15-year mortgage. So basically that person paid off his property for him.
So I have a couple of clients that do Section 8 in an area called Bowie in PG County of Maryland. I'm curious, and then we're talking like $4,000 plus because of like the 5-bedroom. I'm curious which areas he does it in. So I don't know.
Well,
I'll have to check it
it'll
out.
be live next Tuesday, but the podcast episode will be dropping this Friday on Gus's channel. But
Cool.
and I think
I'll check it
Zuber, and we connected him with Zuber because he asked if he could get on Zuber. So I think he's gonna be recording with Zuber on Sunday also. Let's see. Is there any more? Let's see.
You know, there's a question in there, chat, that I wanna talk about, if you don't mind. That Troy Roberts said, "Let me ask you guys, what strategy would you recommend first-time investors that only can save $300 a month, but want to invest in real estate, but their market entry is $500,000 per year?" You see, is it? I think that, you know, that's a question I hear all the time, and it is one. Again, I think this comes from people being sold courses about, okay, invest in real estate with little to no money and that sort of thing. I'm a big believer that everybody should invest in real estate, but I think you should do it from a position of financial strength. And so a lot of times the right answer is figure out your active income first, right? Figure out, how do I make more money? How do I get a larger down payment, right? The time that a lot of people spend like sort of thinking about researching and looking at real estate, if they spent that time, came up with one side hustle, made significantly more money, and then a year, 2 years later said, okay, now I've got a down payment, now I can do a deal. I think that's number one. I think that's important to do it in that situation. The other thing too is, if you don't already own a home, I mean, I think house hacking is how almost everybody should start. Like, that's one thing where I agree with almost all the gurus out there, like buying your own property where you can generate some additional income from that property. I mean, I started buying a duplex. That was my first deal. I had a roommate on my side. You know, we didn't call it house hacking back then. I just had a multifamily property and had a roommate. But it's, you know, the math is still the same, right? Like and by the way, I had a 6.5% interest rate on that loan, so not too different from today. And rent to price ratios were pretty similar. Sorry.
I was going to ask you. I mean, I feel like now more than ever, more younger kids should be talking about that and doing it more. I mean, the average age of a first-time home buyer is 40, based off of the recent data. Obviously, there's less sales, so less data. So if you're, and again, if you're 25, 28 years old, I mean, you're clearly going to be, majority of people are going to be renting. So if you are in a position to go buy a 3-bed house, rent out 2 rooms to your friends, I feel like that should be something more prevalent now, but I'm not seeing a lot of people doing it. I'm just curious, in your world, are you seeing that? Yes
I
or no?
100% agree with you. I don't think people are doing it enough. I've got a good friend who just bought his second home doing that. He works in an industry where with a bunch of other young people, they make good money. It is a, hospitality focused industry, we'll say, but he's he bought his first place and he's renting out rooms to other people that he works with, and he just bought his second place a month ago and is doing the same thing. And the people that are renting from him could be doing the same thing. They make, they literally are coworkers, they make the same money. He's, by doing it on the first, they hang out together, they do a lot of the same stuff. So the only real difference is he's the one who bought a home and rented to them, and then that gave him the ability to save up in just a few years to buy a second one. Yeah, I mean, that I originally got into real estate investing because I rented a room from somebody who was doing the same thing, and I was like, oh, that's kind of cool. And when I moved out, I later realized that me and my roommate were basically paying his whole mortgage, because there were 3 of us that lived in the home. And so, like, yeah, I think it's a great strategy. It's definitely one that is not used as much, and I kind of blame colleges for this. Like, I think if you think about dorms 20 or 30 years ago, like sometimes you had 4 people in a room, right? And like now college dorms are like ridiculously nice. Everybody's got their own room. Like it is the standard of living that young people expect now is so much higher. So a lot of them are like, oh, I don't want a roommate, like, because they don't see that as a step up from I just lived crammed in a room with somebody else. Like I had, you had somebody else sleeping 2 feet away from you, and so moving out of that and then having some place where I rented a room to somebody seemed like that was a huge step up. So I think that's part of what's going on.
I kind of want to touch on this because you guys are talking about house hacking. This is a question comment that was posted in school, so I think it could relate to the topic, and you guys can maybe give some perspective from a lending side or how you would handle it. But this person says, how best to buy a live-in duplex coming from a single-family home. So I have made several offers this year on duplexes, and every time I ask my mortgage guy, local credit union, he says I can't go from a single family to living in a multifamily unless it is extenuating circumstances. I own 2 single-family homes and 1 duplex. I live in one of the single-family homes. I'll kind of leave it at that. I guess that's kind of the gist of the.
And I had actually answered him on there a little bit, but I'm curious because I know, like I said, I have a lot of experience in lending because I've been a borrower and work with borrowers, but I'm new to the mortgage origination side, so I'd like to hear what Joel has to say first, because I think he's probably got more insight into it.
Yeah, I mean, obviously the whole thing is you're trying to prevent somebody from gaming the system to take a primary residence loan, rates, down payment to buy a rental property. And I actually had somebody recently who went from a single family home, a massive home, in Texas, and then bought something in Indiana, a multifamily in Indiana. And the story is what matters, right? They don't have any kids, right? So they don't need to have a certain number of bedrooms. They were renting out rooms already, and we had documentation on that. And then they were going to be going into a 2-bed, 1-bath set of units. And so the story matters. And so if you can show that it's some way not a massive downgrade, that they're clearly going to be renting out the entire place, you got a shot. But it's all about the way you package it, and the story has to make sense. And it's got to be some type of improvement of scenario, or, hey, like this house, I bought it for way too much a couple years ago. Yes, it's got a great rate, but I'm gonna be in a better financial situation by renting out the entire place and cash flowing nicely on it. And I'm gonna downsize into something so that I can be in a better situation financially. I've seen that happen. We've done it before, but the story has to make sense. It has to make some type of logical sense, and so it just depends. It's harder to do for sure going from single into a multifamily, but it's not impossible. Just gotta have to really, plan it through and work it out.
Yeah, and that's what I've seen having clients deal with this same issue, right? And I think they always just make you write a letter that's basically they can put in the file to protect them, I guess, saying this isn't just because they're trying to prevent you from pretending that you're going to move into that and don't really. But I've seen people use like, okay, it's closer to my work, but it had to be like significantly closer. I did this one time. I'm trying to remember. I actually ran into this once, just moving from a single family home to a condo, renting out the single family home. And I'm just like, no, I'm lazy. I don't want to mow the lawn anymore. Like the condo, yes, it's smaller, but
I agree with
it's
that.
just a much nicer living environment, so
Yeah.
I've got a pool that I don't have to take care of. Like, so yeah, I think that, that's been my experience as well. It's just, you have to be able to tell a good story, and it can't be, I'm trying to build a real estate portfolio here.
To that point, kind of relating it to also Troy's question on how someone could get started. And I think that's also why, Lumberjack, a lot of people follow, if possible, if you can get to this person before they really get into their journey. The 4-3-2-1 method that he likes to talk about, it is probably a very good way to get in if you can start with a quad. Now that I believe you can put 5% down, right, for the quad, but you have more reason when you say, I'm going to, go to triplex now because I want to.
Yep.
So that's a great strategy if you can get to that individual before they
one,
actually get.
One of my two little sisters that I got into real estate investing, this is how I did it. She did a fourplex first, then she moved to a duplex, then she moved to a single family home that had some land that she could subdivide off. So she skipped the triplex, but triplexes are hard to find in a lot of markets, But yeah, I completely agree. As if you start with the densest multifamily, it's always an easy story to get less dense. It's tougher to go the opposite direction.
Hyder also shared one of Gus's new podcasts. One of the regulars in the ORAC community, Millennial Mike, was on the podcast, but also Ellis, Dirty Title Goldmine, who's kind of frequently been popping into the chats on my channel. And Ellis does have a school community also of his own. It's basically under Dirty Title Goldmine. So definitely go check that out if you want to kind of interested in that space of real estate. Let's see. Ooh, Troy Roberts is saying, Joel, wait, who are they cheating if they own or occupy a multifamily and there are not enough buyers?
Taxpayers. Because it's a government-backed loan that's making your owner-occupant rate lower, right? It's because of that guarantee, and so that's why it's specifically supposed to be used for certain things. And I'm sorry, I think he said Joel, not Joe. Whenever you say Joel, I hear Joe too. Like there's very little difference in how you say that. But I just looked at the comment. Sorry.
I'll just call
you're
one the
talking about
guru and
FHA specifically, right?
Yeah.
Well, I mean, even
FHA
conventional loans are
I mean, yeah. I mean, it's more the bondholder, so to speak. I mean, I guess the government has ownership in Fannie still.
Yeah,
a little bit. But I
mean, that's why there's so much protection around those. Yeah, but yeah, it's a good point. Yeah, you're cheating bondholders too. But like, the reason that exists is like before the government got involved in the mortgage market, everybody had a 10-year mortgage that they put 50% down. Like, and then you got all these owner occupant things where you stretch it out to 30 years because of government intervention. Like, all of that stuff doesn't exist. And so people trying to take advantage of that system to invest that's who's the loser. Now, yeah, does what this one person's doing affect it? No, but like if you have if you just let that run rampant, that's the real problem with it.
I mean, the real problem from the 08 crash was the stripper loans they were giving out. Too many strippers getting houses.
So my first duplex I bought, I was working a summer job in between college and grad school, and I worked there for like 6 weeks and used that income to qualify 100% financing because I used a VA loan, but got paid by my lender. They paid me like a point to close it, and I got paid by my agent at the time too, because they were just starting to do these agent rebate things, and it was before people realized like, oh, that doesn't make a lot of sense to do that. I know some agents still do it, but it's ridiculous. So like the day I closed, I got back more money than I had put down. Like, I mean, it was stupid, right? Like that loan should have never happened. Now, luckily it was a duplex and I had a roommate, but like, yeah, I mean, it was so easy to get money back then. I mean, it was silly. It was far beyond, I don't know. Whenever people compare this time period to 08, I'm just like, you just have no idea how easy it was to get money back then. And just like, I mean, my second property I bought, you could get a 80% first mortgage and a 20% second mortgage. That's how I bought my second property. Like, every 100% financing, you didn't have to be creative. Your bank just gave it to you, so.
I just want to, so Hyder, I do not see Troy's comments also in the YouTube chat. It is showing up on the stream chat. So I'm not sure exactly where Troy may be commenting from. It looks like YouTube, so it's kind of weird his comments aren't showing up in the actual chat. But Troy also adds in, but was incentivized for first-time home buyers was the purpose. I believe he's talking about his previous, about who were they cheating. But they wouldn't be a first-time home buyer. Yeah. Okay. Anything else you want to? I know Joseph. We can also, either like the San Antonio market, because I know that's where you are. I mean, I know you're big on that area, but I also want to bring up. You had a post in school about kind of networking, maybe communicating with others, and kind of how you're building those relationships. So
yeah, so I spend a lot of time on social media because I don't really get off the couch, and so I like to make, every once in a while I like to see like, okay, where did I actually meet people that I'm building a real relationship with, that I'm talking to other than just whatever form I'm at. I think this is interesting because like I think Joel and you, Mark, I think both of you, I found you through Twitter originally. That would have been the first place. And I find I make a ton of new relationships on Twitter that turn into real life friendships, business relationships. I used to make tons of those connections through Bigger Pockets. I don't use that forum as much as I used to, although lately I've been trying to post there a little bit. I've gotten a lot of activity from YouTube, and then I created a Discord so people could actually talk to me. And so I have some friends from the fractional side that I still talk to all the time. I actually think, and so when I was looking at school, I'm like, I've been a school member, I don't know, a little over a year now. It's one of the only ones that I'm paying for. And I just really, even though, I interact on there a lot, I just haven't come away with the same connections. And I think part of it is it's a much smaller community. I do think, I want to just call this behavior out. I'm not going to mention any specific people. It's really clear that some people are motivated by the leaderboard, right? Like there's a lot of posting that seems like I'm just trying to post something because I'm trying to keep my numbers up. And I think that that's never, it's not the way to actually build relationships. And I think that's the only reason that you should be on social media is to build relationships. Like if I'm not doing business with these people, if I'm not meeting them in real life to be friends, if there's not some additional connection, like I don't want to be on a forum just talking just for the heck of it. So, and that's what I realized. Like I just haven't made the same connections there. And I wanted to mention it because I wanted to see, well, how are other people doing it? And a lot of people mentioned, okay, I'm on these calls regularly. It's not something that I'm, I just haven't done it. So
I want to just reiterate that Wednesdays is typically meet the school member. So Gus, yes, Joseph is in school. So, but Ray, hey, good morning, Ray. Ray says paste the Discord. I don't know, is the Discord still active, Joseph?
It is active. I mean, it is a fractional real estate focused Discord.
Yeah, I'm in there, but I'm not in there.
Yeah,
I
don't
think
know.
Harrison is in there still yet.
I think I could paste a link to that. Let me see.
If not, throw it in the private chat and I'll throw it in there. Stephen P from the Bronx, he says, Joel, I guess I need to dust off the Speedo so I can apply to those stripper loans. I gotta get better at reading the comments before I share them.
Before we wrap up, because I wasn't able to be here last week because I was in Seattle. We're
That's
coming back
right.
from Seattle. But I had a chance to hang out with a few other school members on Tuesday after I went to the game. The game sucked. I mean, it was cool. Don't get me wrong, but I got because my flight got in at like 2:30 local time. So racing to get to the hotel, racing to get to the stadium, and we got there. It was 17 minutes already into the game. We were already losing. And as we were walking up to the stands, like everybody just looked so scared and like just like distraught, like we were already losing the game. And then we tied the game, and for like a minute, everyone was happy, and then we lost it all from there. But no, Chris Price, spent some time with him, Justin Canberra, Curtis, and Esther as well. And she's working on some ADU stuff, ground up construction stuff, which is pretty cool. Chris Price working on a couple of big hotel deals. Justin building his business. Curtis doing his thing, growing the real estate side of things. So it was just fun to be able to hang out with those guys.
Definitely. Yesterday, Gus, Curtis, and I went live. You definitely got to check that one out. A lot of fun on that. Great information, but definitely a lot of fun. Justin, I'm not sure. I don't see it. Him and Cody Davis usually stream on Wednesdays at the same time, but I do not see their live stream today, so I'm not sure if they had to cancel for some reason. If those of you don't know, Gus is also streaming live on Tuesdays now with Emily and Cody at 6 a.m. Pacific. So that's a new live stream that they're collaborating with. But yeah, Joseph, I know. Hopefully, it seems that you participating quite a bit in the school community. It seems that you're providing a lot of good information. Hopefully, you're building some relationships there. We are trying to hopefully get you out to the Vegas event. I know it's a challenge for you. You said, right?
Yeah, and that's what one of the things. Like, I really don't get off the couch that much. Like I have a disability. It's why I've shifted from doing real estate myself to having a team that does the real estate agent activity for me. But it is, like I'll go and do like social things that are like an hour or two somewhere, but like going traveling and then doing a multi-day like events. It's just like I'd have to bring my couch with me. I don't know. So there's definitely some parts in the year that I could do that, but like it just goes up and down. So knowing ahead of time, if I end up going out there, it'll just be last minute. Like, hey, I'm actually doing pretty good right now. Let me come do this.
Flavio is saying looks like they are live streaming. So yeah, if you want to pick up some other information today, go check out Cody and Justin. But yeah, let's quickly talk. I mean, I don't know how much time you guys got, but I know maybe some people are down on the Texas market. The prices are coming down. Insurance, things like that. But you are in San Antonio, and every time I hear you talk or we connect, you're very big on the San Antonio market, right?
Yeah, I'm a big fan of our market. I moved here specifically, in large part due to the real estate opportunity here, and it is. I mean, we've had some pullback in pricing. It hasn't been, we didn't crash the way Austin did, but we've moved down. A lot of the numbers, when you really look at it, is our average size of home has shrunk considerably that's selling, because Lennar and now even DR Horton are putting out a ton of these smaller homes. So a lot of the like headline price declines here is not completely accurate, although we do start to have some. The reason I like this market, it is one, we've just have like a very long history of population growth. And I think that, as a residential real estate investor, it's the number one thing I look at when I'm looking at a new market. If you have declining population, you have declining demand, right? And it's really easy to get a hold of demand numbers for markets because census publishes this everywhere. Now at this, it's tougher to get a handle on, well, what does the supply look like? And that's one of the reasons our prices don't go crazy here is because we just keep building, right? Like it's so but over the very long term, we are having a difficult time keeping up with that growth. But we also just have one of the most diverse economies, of the large Texas cities. There is no single employer that could go out of business or sector that would crush us, with the exception of, we have the largest joint military base in the country here. And if it got wiped out entirely, that'd be a problem. But we went through a base closure during, I think it was the last round of base realignment and closures. It might have been the time before, but it was almost 20 years ago at this point, I think, that the city just sort of swallowed that up, where like a lot of markets, if you had a base closure in that market's gone. Like a lot of people talk about Killeen, Texas, it's where it's not Fort Hood anymore. I don't think I don't remember the fort, but it's a military-based town. And like a lot of people are like, oh, look at the numbers there. They're fantastic. But if that base shrunk or got closed, that market would completely disappear. And so we're a big enough city where that's not the case. We actually just became the 6th largest city. We passed Philly this year. And we're just, we have very good landlord protections. So there's just a lot of reasons to like, and those are all like reasons to like the city and the market, which is more important to me than, I don't start off with, well, what are our rent to price ratios here, right? And we are one of the most affordable large cities, but our rents are also extremely affordable. So this isn't like nobody's coming here for the crazy cash flow, but it is a very, like, if you're looking for a stable market, strong rent growth and appreciation expectations just relative to other markets because of where we're at, if you look at our rents, if you look at our prices, if you look at the way the city and businesses and employment are growing. I think that, I'm like, again, I moved here in 2018, trying to find some place where I could stay long-term that I thought would handle, that far back, right? 8 years ago, I was already wondering, okay, when's the next crash going to happen? Because if you look at like how San Antonio behaved for the last crash relative to a lot of other markets, I wish I was here then, so.
I have to add on. I mean, now that we did speak about stripper loans, I have to add this in here. Speaking of the city of St. Louis, if I include the metro area, including East St. Louis, which clearly there's lots of strip clubs if you're familiar with St. Louis. If I include metro area, St. Louis has more population than San Antonio, like 2.9 to 2.7, something like that. Just saying.
The MSA.
Yeah.
Yeah. So that's definitely true. So yeah, city-wise, we're the 6th largest city. We're like the 25th largest MSA. But the main reason for that is because our MSA bumps into Austin's. And so basically if we were 30 miles closer to Austin, we would be the San Antonio Austin MSA, just like Dallas and Fort Worth is. But because we're not, they get San Marcos, we don't. Like there's all these cities that are in between. So it's I think our MSA is actually underreported if you just when you just look at market size, but it is, it's a really interesting, I like talking about this because I think it's one of the things I spend a lot of time looking at. Like, I think because I started on the institutional side of real estate investing, we always, you had to be in certain size markets. You had to look at the MSA, you had to look at that stuff. And so, yeah, I mean, it's so people are always surprised to hear San Antonio is the 6th largest city. They're just like, no way. They name all these places, and every place they name has a bigger MSA, but they have a smaller city proper. I actually think there's some benefit to investing in a large city versus a large MSA. Because, for example, my codes don't change, right? I'm always dealing with the same code office. I'm always dealing with the same planning and zoning. Like when I worked in New Jersey, I mean, there was the population density there was so much more than here. But there was there's literally 500 different municipalities in that small state, right? And so you'd be running around to different county courts to deal with evictions, different code officers. So there's reasons to be there's advantages to both, I guess, though, too, because
sure.
in New Jersey you could find like some little town where other people really weren't operating very well and just kind of take over because you had a good relationship.
All I care about is if you have a Buc-ee's near you. That's what I care about.
Yeah, I'm about 25 minutes from Buc-ee's. So I go.
Well-
Sometimes I just drive there for the fudge, just so you know. There's no reason other than I leave my house, drive to Buc-ee's, and come home. So.
But just people probably that tuning in, a lot of people follow the One Rental at a Time, so I'm sure they all know Dion has relocated. I believe just outside of San Antonio. So Dion does like that market also. But Ellis does chime in. Property taxes are tough in Bexar County, and rent compression adds complexity. Supply is the killer in Bexar County as well.
So that's Bexar County. You don't pronounce the X. Just
FYI.
That's the county San Antonio sits in. And yeah, property taxes are definitely tough, and supply is it is what is keeping our prices low, because right now Lennar's just pumping out a crazy number of small homes. A lot of investors are buying these, though. I mean, there's a brand new construction 2-bedroom 2-bath home for sale for $120,000 right now in the city limits, right? They have a ton of new construction homes that are like 3-bed 2-baths around 1,000 square feet, like in the 160 price range. But you're probably going to get $1,200 a month in rent for those because tons of investors are buying them right now. And yeah, property taxes are, if you invest here, you have to appeal your tax appraisal every year. Like it's just part of being an investor here. And that rate's high, but it's all relative, right? It's just one number on the spreadsheet, and it is there's just you just have to figure out, does it work, does it not work? And again, he's saying like it makes it tough to pencil long term. And again, I think that's just taking into consideration, if I want an 80% levered deal, well, it's not, cash flow is tough. You can get cash flow, but it's tough. You're not getting fantastic cash flow. But if you want to pick up, we have clients here that have 60 plus homes in this market, that none of them probably looked amazing on paper when they started buying them, but now, with the benefit of time, become amazing cash cows as well. So it's pretty easy to pay off. If you bought it for a 150, it's pretty easy to get those paid off over time, depending on what your income looks like too.
All right, I don't know how much time you guys got, but if maybe we'll get to the last few questions before we wrap things up. And like I said, if you haven't connected with either of these two in the school community, message them. Definitely always willing to chat these fellas, so reach out to them. But Ellis adds in, if rents don't increase and values don't increase substantially, then what's the appeal? What he's talking about.
So yeah, if both of those things are true, but if you look at our history, yes, there's been a slight decline in rents. The rents that we're getting today are a little bit lower than 2 years ago. We had like this very short period of time where rents popped, like we had a huge jump, and now as we're releasing those units, they're not as high. But if you look at the long term, I remember when we were getting $500 or $600 per side on duplexes, and now those are $1,200. Like over the long run, this has been historically a strong rent growth market. It hasn't been as much of an appreciation market, but I think that we are starting to see more of this. Like we're continuing with the population growth, and we're starting to see supply constraints. Like if you look at where the building's happening now, it is further and further out. We have a really good forward-looking plan as far as highways go, but it's still like if you're on the west side where we were expanding really rapidly, it's getting tough traffic-wise to continue to commute from out there. So especially, a big part of it is it's a big market. You have to know where to buy in the market, right? I mean, yes, if you know, and where the right places to buy have changed over time. Like 3 years ago, there was one little spot in town where almost everything I sold was there because it was a relatively new elementary school that was extremely highly rated. Prices in that particular neighborhood went up, probably 50% more than prices everywhere else have moved in the same time period. And so, it does still come down to picking the right assets in the right parts of town. You can't just say, I'm going to buy anything in San Antonio, right? Like uh, it's all about understanding the asset, the market, the area a little bit more than the next person. And that's how you get your edge in this game. So.
I'll just quickly read some. Brady says, I was in Houston when I started investing, saw the overbuilding happening all across Texas, and got out. Sold my last rental there a few years ago. Been very happy with that decision. Brady has a great YouTube channel. Go check him out. He's doing build to rent in his area, or new builds. Yeah, build to rent. And we'll Marlon says, why is Joe repeatedly hating on strippers? Did he fall for one?
Fell in love with a stripper.
Well,
This time I know you said Joel, not Joe.
All right, I think that's a great spot to wrap it up. Let's see the people. Oh, I will just wrap it up with it. Harrison's asking, Joseph, are you investing in the Texas Stock Exchange?
No, I don't invest in stocks. So I'm almost almost a pure real estate investor, and then precious metals. I have an old guy portfolio, basically. I like stuff that I can go and touch or that I can bury somewhere.
Very cool. Any final words from you guys before we wrap it up today, then?
If you are in school, feel free to reach out to me. Most of my day I'm kind of bored, so I'm happy to talk to new investors that want to hear long rambling paragraphs of advice when they ask simple questions.
If not, definitely go check. If you're on X, definitely go connect with Joseph there. He's probably you spend most of your time, I would say, putting out content, right?
Yeah, I post a lot on X. I've got pretty good, and the last couple of days, you can see their algorithm has changed back to where it's really easy to connect with other real estate people, where for a little while, like it got really spammy and trashy. But I talked to more people yesterday on X that I hadn't talked to in months or years. Like it's a very noticeable change for the better.
There's a lot of people saying the same thing about that.
It's crazy how much it changed, because there's tons of real estate people that I used to talk to all the time on there that I just sort of lost touch with. So.
The other thing too is that you have your For You tab, but then you also have your tab that says following, so you can adjust your feed to following. So which I didn't know that until like maybe a week ago.
So I've used the following, but it's not like, I'm following 5,000 people because I follow back most of the people that follow me, and so it is not. I'd have to go and like really scale back who I follow for that For You tab to be as useful.
Yes, Gus, you need to get on X. I tell people I think X is probably the best place for kind of business wise or real estate wise connect. Like the other platforms have their purposes, but I think as far as like connecting for certain things, X is probably even information wise, I think it probably gives you the most wide variety of information.
Yeah, and I think that the way, I think it was Gary Vee who described it like this a long time ago. X is like, it's the cocktail party of social media. Like, people expect you to walk up into somebody else's conversation and get involved, where a lot of other platforms are less like that, right? Like, it is more group based or, people I know based, there's, if on Facebook, it's much weirder to jump into somebody's conversation that you don't know that person. On X, it's expected, so I think that's why I liked it initially. And yeah, it is, honestly, I think you could trace 80% of my team's business back to X, which is crazy to say, but I'm pretty sure that's true last time I checked.
All right, very cool. Everyone, like I said, if you haven't connected with Joel or Joseph, reach out to them. We'll wrap it up today. I will be back Friday with Emily Lopez. And that's it, everyone. Thanks for tuning in again, and have a great rest of the day.
Awesome. Thanks for having
See
me.
y'all.